Robocash has consistently ranked among the best performing P2P lending platforms for investors over the past few years. Even during challenging periods such as the COVID-19 pandemic and the onset of the war in Ukraine, the platform maintains its commitments to investors, a track record it continues to uphold today. There are no pending payments or withdrawal delays, and the availability of a secondary market allows investors to exit the platform within 24 hours, a level of liquidity that many competitors cannot match. However, strong historical performance alone is not a guarantee for future success. That's why it is important to periodically re-evaluate the platform's financial health and monitor recent developments with a critical eye. In this 2025 Robocash update, we'll do exactly that, taking a fresh look under the hood to see if the platform still lives up to its reputation. As I record this video, all of Robocash's features continue to function as expected. However, it's important to keep in mind that Robocash is simply a financing vehicle for the lending operations of the Una Financial Group. The group issues loans to borrowers in Spain, the Philippines, Sri Lanka, Kazakhstan, and most recently also Uzbekistan. These are the operational entities currently listed under Una Financial as of the most recent financial statements for 2024. One key concern is the lack of transparency around how Robocash deploys investor funds. Most of the capital is funneled through a business loan to Robocash Singapore, which then redistributes the funds internally at its own discretion. Although the platform publishes some high-level portfolio data, we cannot be certain how diversified the underlying loan book truly is. To better assess the investment risks associated with platforms like Robocash, we have developed a new country risk scoring model. It evaluates the risk exposure across different markets using publicly available macroeconomic and governance data. The model takes into account several critical variables, including GDP per capita, inflation, credit ratings, rule of law, corruption index, access to credit, currency risk, regulatory environment for non-banking lending operations, non-performing loan ratios for banks, and mobile as well as internet penetration rates. Based on this framework, Spain ranks as the lowest risk country within Una Financial's lending footprint. Kazakhstan and the Philippines fall into the moderate to high risk category, while Uzbekistan and Sri Lanka are currently classified as high risk. Our evaluation system is regularly updated to reflect the latest available macroeconomic data. While it's not foolproof, it provides a structured way to assess the country-specific risks of my investment, so I don't have to rely on platforms' marketing claims about how promising it is to invest in a developing market. A simplified version of our country risk evaluation system will soon be available on P2P Empire. For those supporting us on Buy Me a Coffee, a more detailed version including a full table with all risk indicators will be accessible exclusively to members. So now that we have determined the country risk from a macroeconomic perspective, now let's have a look at what the financials say about Una Financial's performance. Here are some financial indicators that every P2P investor should pay attention to. Let's start with the equity to assets ratio, which reflects the portion of a company's assets financed by its owners rather than creditors. A higher ratio indicates stronger capitalization and greater buffer to absorb potential losses. This capital cushion is essential when assessing the long-term sustainability of a loan originator. In the case of Una Financial, this ratio dropped from 8.10% in 2023 to just 3.83% in 2024. According to our risk scale, that shift moves the company from moderate to high-risk territory. The second key metric is the debt-to-equity ratio, which indicates the degree of leverage the company has. A high ratio means the lender relies heavily on borrowed capital. This increases default risk, especially in the event of a sudden shock. It also raises questions about the reliability of buyback guarantees, which may not be honored if the company encounters financial difficulties. For Una Financial, the debt-to-equity ratio rose sharply from 11 in 2023 to 25 in 2024. This jump moves the company from a moderate risk to a very high risk category in just 1 year. When examining the country risk in conjunction with the audited financial statements, it becomes clear that Una Financial is neither the least risky nor the best performing lending group. What's worth noting is that the interest rate offered by Robocash doesn't reflect the risk, but rather the management of loan supply and demand among investors. Currently, the platform offers interest rates between 8 and 10.5% for a relatively risky investment. Based on my recent evaluation of their financials, I sent Robocash a bunch of questions which the CFO addressed in a recent business update video on Robocash's YouTube channel. Firstly, I asked the CFO to explain the worsening debt-to-equity ratio. He acknowledged the issue and mentioned that the company is actively deleveraging and focusing on profitable business business units. He mentioned that the ratio has improved in the first half of 2025. However, he was not very specific about the group's liquidity ratio, nor did he explain what caused the translation reserve adjustment. What's also worth mentioning is that the reduction in assets was caused by the company's exit from the Vietnamese market in 2024. He goes on to further explain that the company's core operations were profitable in 2024. Despite the profit, the overall equity value decreased due to the foreign currency translation losses. These are accounting adjustments required when the company consolidates results from subsidiaries that report in local currencies into US dollar. These losses occur when the value of foreign currencies drops against the US dollar. For example, if the group has large operations in Kazakhstan, the Philippines, or Sri Lanka, those currencies depreciate significantly. The USD value of those subsidiaries shrinks, even if the local operations remain stable or profitable. Additionally, I was wondering about an update of the revocation of the lending license in the Philippines. The company continues to attempt to clarify and resolve the issue with the regulator. However, it remains unclear whether it is currently permitted to operate and how this impacts its operations from a risk perspective. When I asked about how the funds from the business loan in Singapore are being used, the company provided a rather non-specific answer, claiming the money is being used for opening new businesses or introducing a new product line in Asia. What's also worth mentioning is that the CFO reconfirmed that Financial is not providing a group guarantee for its entities. It only provides oversight and financial support, meaning should a lender not be able to honor the buyback obligations, the company would enter formal insolvency proceedings. The CFO goes on to address additional questions from the community about its best performing markets, such as Kazakhstan and the Philippines. If you would like to learn more, I suggest watching the full video. So to wrap things up, after reviewing the audited financial statements, it's clear they paint a more negative picture of the company than what was communicated by the CFO regarding its 2025 performance. Some of the deteriorating financial ratios have been attributed to the exit from Vietnam and unfavorable currency valuation effects. The additional information from the CFO is certainly appreciated. That said, several uncertainties remain. For one, the issue surrounding the lending license in the Philippines still hasn't been resolved. Additionally, the company has not provided audited financial statements for its individual lending entities. Instead, it continues to raise funds through a business loan structure with limited visibility on how those funds are allocated. To be fair, Robocash has been a reliable and highly liquid platform for P2P investors up to this point, but the risks tied to lending in developing markets should not be underestimated. The platform is currently in a favorable position, with investor demand exceeding loan supply, which helps maintain liquidity. However, I do believe there is room for improvement, especially in terms of transparency. We are still missing detailed financial reporting from the underlying lenders, as well as deeper insight into their lending operations. Whether you should continue investing or take a step back ultimately depends on your own risk tolerance. As for me, I've currently exited my position on the platform. The combination of elevated country risk and weakening financials just doesn't align with my risk profile at the moment. There are other lenders in the market that offer stronger financials, although they may not offer the same level of liquidity as Robocash. So that's it for this update. If you found it helpful, consider hitting the like button and subscribing for more insights. Thanks for watching, and I'll see you in the next one.